How do import quotas affect global agricultural markets? Imagine a world where countries set strict limits on how much of certain foods can be imported. This is what import quotas are all about. They are limits that a country places on the amount of a specific agricultural product that can come in during a certain time. These limits can be in the form of tariff rate quotas, which let a certain amount of goods enter at lower or no tariffs, but charge higher tariffs on anything beyond that. When a country enforces import quotas, it directly affects how much foreign agricultural products are available locally. This restriction usually pushes up the prices of those products inside the country because there are fewer options for consumers and businesses. Domestic farmers and producers often benefit from higher prices, but shoppers and industries that relying on those imports might face higher costs. Trade patterns also shift because of these quotas. Countries that face import limits may look for other sources to meet demand. For example, if China limits soybean imports from the United States, it might buy more from Argentina or Brazil. This change can reshape global trade flows and influence farmland values in those exporting countries. Quotas can create uncertainty for investors and farmers. If a quota limits exports, farmers who depend on selling crops abroad might see less demand, which can lower farmland prices in regions that relying on export markets. On the other hand, if quotas protect local farmers from foreign competition, farmland values might stay steady or even increase. In many trade deals, import quotas are used as bargaining tools. Countries may adjust quotas to protect sensitive sectors or open up others. Changes in quota levels or tariffs within those limits can make markets more or less competitive, affecting farmland investment strategies. Farmers and agribusinesses often change what they grow based on these restrictions. If a quota limits imports of a certain crop, farmers might plant more of that crop domestically to meet demand. This can lead to shifts in land use and new opportunities for farmland investors. Understanding import quotas is key for anyone involved in farmland investments. These limits influence the demand for crops, the prices farmers can get, and the overall profitability of farmland. Keeping an eye on trade policies and quota changes helps investors make smarter decisions and stay ahead in the global agricultural markets.